Hello, everybody. This is Scott Hubspath with Agent Mastermind. Welcome to the call, and I'm your host, along with a good friend of mine, and he's been here before. And I got to tell you, man, Vern Moter, is that correct, Vern? Vern Moter?
Yes, sir.
Is a licensed. What's the term? I'll let you say it so I don't mess it up.
Certified public accountant.
Certified
Don't
public
think
accountant.
I'm boring, though.
Okay. Okay. All right. This is definitely not a boring class. So what? Since the last time, Vern was on with us in April, and has done some amazing things with a couple clients that he's worked with from the class. In fact, to the tune of about $4,000 per month on a minimum that the people he's working with, all the way up to the new success story is $30,000 in 1 year, and that was going back to 2013, correct?
Yes.
So what we're going to share with you today is whether you take it and go to your accountant and share some strategies with them, or you hook up a call with Vern to talk to him about it. But guys, this is, I don't know about you, Vern, but I hate giving money to the government more than I need to give. So if there's a strategy, some way, shape, or form, and I know you and I are talking on Monday, and I can't wait. So looking forward to that call. But if there's some way, shape, or form that I can put more in my pocket or put more as an investment somewhere and not have to give it to the government, I tell you, I'm all over that. So I got my notepad. I'm gonna listen, and you got some new stuff to share with us on top of what you shared with us in April. So really looking forward to this, man.
Perfect. Well, today I'm going to show you how to save up to $50,000 on your income taxes every single year. Now, I know that's a bold claim, but the promise I'm going to make you is that I'm not going to waste your time. You're going to learn at least 2 core strategies is what I'm going to teach. But out of those 2 core strategies, you're going to take away probably 8 to 10 different nuggets that you'll be able to implement in your business and in your tax strategy that will save you several $1,000s per year each. So let's just dive right in.
Let's do it.
$1 billion. What's that mean, right? That's the amount of money. Yeah, that's the amount of money that taxpayers, you and I, the folks here in the US of A, overpay Uncle Sam every single year. Now, some of you are probably saying, oh, that's not me. Really? 60% of those returns are prepared by a tax preparer, all right? In your industry, everybody's not created equal, and unfortunately, in the CPA industry, everybody's not created equal either. So I'm sure you've seen the commercials, like during the Super Bowl, you had the guy walking around putting piles of cash on every stadium seat, and then the geeky accountant guy comes on, and by the way, I don't look like that either. He comes on and he says, hey, we're going to fill up every football stadium in the country. That's what $1 billion looks like. So
wow.
You're paying too much tax, I guarantee it, and I'm going to show you some ways to alleviate that.
Very cool.
Well, let me ask you a question first. Who's a better steward of your money? Do you think you are or Uncle Sam is? I mean, Scott, you just said it. I hate paying taxes into the government. I'm willing to pay my fair share, but luckily there's ways that we get to control our fair share, and Uncle Sam doesn't have to. I mean, every time I write a check, I feel like I'm enabling an addict, right? Our spending is just out of control. So anyway, I won't get political on you. What I will ask you is, what do you really want? It wasn't very long ago I got to listen to Kevin O'Leary speak live, and you guys know him from Shark Tank or have heard about him, Mr. Wonderful. You either love him or you hate him. It doesn't really matter. But he says
his famous line, "You are dead to me."
Yeah, right. You are dead to me. If I put my money with you, it will die.
Oh, that's right.
But what he said is, you know what, I ask all these people, what do you really want? He said, I get these answers like, oh, I want happiness. Oh, I want peace. Oh, I want financial security. And he said, those people don't really know what they want. He said, really what it boils down to is what you and I as entrepreneurs want. We want freedom.
Amen.
And he says, what gets you your freedom is wealth. Wealth equals freedom. Not that freedom's just money, but that buys you time, right? That's what money does and wealth does, is it buys you your time. So you get to control your time, and that's really what freedom's all about. So let's dive into core strategy number 1. Core strategy number 1, I call this C corporation strategy. So what does that mean? Well, let's talk about what most people do. Most entrepreneurs, when they first get into business, they set up a sole proprietorship. Why? Well, because it's easy, right? You can pretty much say, hey, I'm in business, and here I am. I hang out my shingle. So that sole proprietorship's easy, and Uncle Sam makes it easy for a reason, because sole proprietors pay the highest amount of tax. Not only income taxes, they also pay self-employment taxes. So they pay the highest amount of tax. And there's no liability protection. You may not be in a high-risk industry, but the reality is all your personal assets are at risk in a sole proprietorship. Oh, let me back up. Let me give you an example. I'm going to switch back and forth here. Hopefully it's not too annoying, but I like to draw, and you can see that I'm a better CPA than I am an artist, but I'm going to draw a bucket here. I used to draw like circles, and an attorney once told me you cannot put anything in a circle, you have to draw a bucket. So this is our sole proprietorship. Now I don't know what your income is, and some of you might be lower than this, some of you might be quite a bit higher than this, but I'm just going to say, hey, in our sole proprietorship, we're going to make $300,000 bottom line income, okay? So in a sole proprietorship, at $300,000, you're going to have to pay self-employment taxes. Now that totals 15.3% total, okay? But now part of that's Social Security and part of that's Medicare. So our Social Security tax on that's going to be $18,000. You pay that on the first $117,000, then you get to stop paying it. But then you got to pay Medicare, and that goes on all your income, plus now there's the additional Obamacare tax. So that number is going to be another $5,300. So before we even get started, we're paying $23,300 in self-employment taxes. Now I'm not sure, I asked you who was a better steward of your money. You can look at Social Security and see what Uncle Sam's done with it. Yeah. But if you don't have to pay it in, you're probably not going to get that back if you do pay it in. So now for this illustration, because I know Schedule A deductions, itemized deductions, you get to deduct your mortgage interest and your taxes and things like that. I'm going to use a standard deduction just because I don't know your personal situation, and quite frankly it keeps the math easy. So your standard deduction on $300,000, and you lose your exemptions because you're making too much money, and you get a partial deduction for that $23,300. So we're going to get $22,000 in standard deductions. So we're going to pay tax on $278,000. Okay, well it came down a little bit. So we're paying $23,300 in self-employment tax. The tax on that income is $65,700. I hope you guys aren't out there laughing about my artwork because I know it's not very good. But this is $89,000 in tax on $300,000 worth of income. That's a lot of money going to Uncle Sam. Now this is also, that's just Fed, right? That's just U.S. Depending on where you live, you might be lucky enough to live in a tax-free, income tax-free state. Right now I'm sitting in San Diego, California. California has one of the highest tax rates out there for states. So in your state you might be paying anywhere from 6%, which is about average, to 13%. I mean, it's huge. That's on top of this $89,000. I mean, most of your money there now is going to taxes. So what do? Oh, by the way, you're in the 33% tax bracket at that income level, okay, plus self-employment income. So let's go back to our presentation here.
And Michael,
a lot of people say, okay, what are we going to do?
Michael Peggin said he's from San Diego too, so he said hello from San Diego.
Awesome, Michael.
Yeah.
Hope to meet you one of these days. So a lot of people say, hey, what do I do? And somebody says, well, my buddy set up an LLC, right? Well, what's an LLC look like? Well, it's a limited liability company. I'm sure you guys are pretty familiar with this stuff. It gives you liability protection. The challenge is, what I like about LLCs is they're flexible. But if they're not used right, there's no tax savings. No tax savings. So the LLC is right up here with our sole proprietorship if you don't do anything different, right? But you can do something different. I told you they were flexible. You can use an LLC and have it taxed as an S Corp, or you can have it taxed as a C Corp. Either way, then you start to see some tax savings. So let's talk about an S Corp. Many of you probably have these, and I think it's a great strategy. I think it's a great strategy when it's used in conjunction with our C Corp strategy we're going to talk about. S Corps are what a lot of people do. You get to save some self-employment tax. Here's what happens with an S Corp, though, is all that income, it flows through to your personal tax return. It has liability protection. The challenge with it is when Ronald Reagan was president and they made the tax law changes, we lost almost all of the super tax savings on steroids, really, with an S Corp. They went away in 1986. And unfortunately, my industry has been very slow to recognize that change. So you pay your tax on your personal return. So all of these other items, a lot of them flow through separately. So the challenge is, with an S Corp, is all the income still flows to your personal tax return. So your tax rate stays high, you lose benefits of things like educational credits, the ability to maybe make a Roth IRA contribution, education credits, things like that, medical deductions. You lose a lot of that because your income on a personal level is still high. But before we go to the C Corp, let me walk you through what an S Corp looks like.
So of the people that you've worked with from the last class, are they main? Because I know you said a couple of them were set up with the C Corp that really weren't taking the benefits of the C Corp appropriately.
Yes, that's very true. Now, from the last class, one of the people, two of the people were just straight sole proprietors. And so we were able to implement the strategy we're talking about right now and save them a lot of money in the future. And I'm going to talk a little bit later about some strategies we were actually able to go back, and they hadn't filed their 2013, and we saved them a ton of money because of that. Somebody else had a C Corp and wasn't using it. Somebody else had an S Corp that they had just never done anything with. And we were able to save them almost $24,000 just by using their S Corp the way it should have been used.
Very nice.
So,
awesome.
Yeah, it was really cool. So we're going to use the same $300,000.
Now, when you say now, just for clarity, when you say save them $24,000, that's $24,000 that they didn't have to pay in.
They had another CPA prepare their return. They hadn't filed it yet.
Okay.
They had a balance due, so they paid in with their extension $29,000. And when we went back and made the changes and actually utilized their S Corp like it was set up to be utilized, they are getting a refund of $24,000.
Oh my God. Okay.
So as I said, all CPAs are not created equal.
Right on.
It's just kind of crazy. So what the IRS says is that, okay, if you use an S Corp, you have to pay yourself a reasonable wage. Now, what is reasonable? They leave that totally wide open. Some CPAs might say, oh, it's $150,000 on 300. I've had clients pay $3,000 a year on 300,000, and that's super uncomfortable for me. I don't think that's reasonable. I've had realtors pay $50,000, and I think that's more than reasonable. So we're going to use that number. We're going to say, okay, we're going to pay ourselves $50,000 in wages. Now they say it has to be reasonable because they know that you have to pay self-employment tax on the 50, but not on the other 250. So we're going to pay $50,000 in wages, and the SE taxes now are $76.50 on that 50. But all this, like I said, it flows through to your personal. So now you're going to have 50 in wages, you're going to have 250 in earnings, so we're still at 300, right? Now your deductions change a little bit because of the self-employment deduction, etc. So the income taxes on that are actually $71.3. You see your income tax actually went up just a little bit because you lost the half of the self-employment deduction. So now that's $79,000. Okay, not bad though, right? Save 10 grand just using this strategy, and obviously your taxes are probably different. You might make more, you might make less, you might have different deductions. That's why we're able to save the other clients $24,000. But $10,000 a year, it's still something to get excited, right? Wealth is created in the margins.
Absolutely. Hey, can you Mimi's asking if you can close those birthday things. She must be on a small screen. It's taking up some of her screen.
Am I on
those birthday things? Are those Valerie over on the right hand side? Can you see them?
Oh, you guys get to see everybody's
birthday.
Sorry about that. I didn't even realize it's on my screen.
Right. No worries. No worries.
All right.
Okay,
now
cool.
I got a lot of cards to send out, don't I?
All right. There you go.
Okay, so that's the S Corp, right? in a nutshell, that's kind of how it works. So we saved a little bit of money. We didn't save as much as we could have. I told you we're going to show you how to save 50 grand. So let's go back here and talk about a C Corp. Now, what is a C Corp? Well, it's just a corporation. The benefits are it pays its own tax. It doesn't flow through to you individually. And C Corps have been around forever, way longer than the S Corps. So there's more, and there's actually better deductions in a C Corp. So it pays its own tax. What does that mean? It has separate tax brackets. So the first $50,000 of bottom line income is only taxed at 15%. Well, you see from our other scenarios, we're paying tax at 33 plus state, right?
Right.
The next 25 is taxed at 25%, and then the next 25 at 31%. So we get lower tax brackets. So our strategy here really is how do we shift income, our global income in your business, to a lower tax bracket? How do we do that? So
interesting.
I'm going to talk about those in a second. Let me walk you through what I like about C Corps. I'm going to draw the S Corp back up here, okay?
You know, I think I missed that.
I like to use them.
I think I missed that from the last time about the C Corp where the first 50,000 is 15%. I think I missed that. So
yeah, so it's a lot lower tax bracket. So then, in and of itself, you're saving a huge marginal tax.
Right.
Plus, when you shift income off your personal return over into the C Corp, you lower your personal income, and then you're not subject to the Obamacare tax, or may not be. You get all your exemptions because you're in a lower tax bracket personally. You get education credits that you might have lost, things like that. So the strategy I like to employ is both. We use an S Corp and a C Corp. You might say, well, how's that work? Well, over here we're still going to have our same 300,000, right? But what's one of your biggest expenses in real estate? Well, I would say it's probably marketing, right? And I don't know what you pay, but for most of my realtor clients, they pay a lot. But when you control where those marketing dollars go, let's just say we hire our C Corp to take care of our marketing. And so we're going to take $150,000 and we're going to pay our C Corp, and they're going to pay all of our marketing expenses. Now over here we only have $150,000. Now again, we still have to pay a wage, and to keep the math the same, I'm going to use the same amount of wages because we're going to pay some out of each. Okay, so we're going to have $125,000 over here, and we're going to have $125,000 over here. All right, so our total income that flows through to our personal returns is $175,000. Now, because we got some of our exemptions back, we're at $28,000 worth of deductions, so now we're only paying tax on $147,000. That's huge, first of all.
Huge, man. Unbelievable.
Second of all, before, we were paying all the surcharge taxes because of the new Obamacare, the 3.8%, the extra 0.9%, plus we're in the 33% tax bracket. Now we're in the 28% tax bracket, barely,
right?
And we're at $147,000. So the tax on that is $22,000. Okay? Now we go over here and we go through the brackets. So we're at $7,500 for the first 50. We're at $6,250 for the next bracket. And the other brackets, we go into two of them, but we're at $7,750. So basically we're paying $21,500 in tax. And again, this is just federal. I'm not talking state. State would be on top of this, just like it is on the other scenario. So we've got 22, we've got 21.5, and our self-employment tax on the wages of 76.50. All that comes up to 51,150. So what did we save? 37,800. Huge, right?
Huge.
Just by shifting income off of your return. Now, I told you I'd show you two strategies that saved you 50 grand, and that's not 50 grand. Even I can do that math, right?
Right.
So let's talk about where that difference can be made up. We're talking about shifting income off your personal return. What about paying your kids, right? I'll give you this free of charge. My pastor, during his sermons, always adds in a little extra scripture, and he says, hey, this is free of charge. It makes me laugh every single time I think about that. But what about paying your kids? You can use this strategy.
I love this idea. I love
any of those, right?
Yeah. Yeah.
So, I mean, I've got 3 kids, and I love them to death. They're 8, 10, and 12, okay? And most of you probably have kids or know somebody who has kids, or maybe you were a kid once. I don't know. So if you pay your kids, let's just think about this conceptually. Let's just say we paid them $10,000. You're thinking, well, I don't know. I can't even get them to pick up their shoes, right?
Right.
Pay them $10,000 from your company. If you're at 33 or 28% plus state, that's probably saving you $3,000 off the top. Now, it's not quite that simple, right? The kids get a standard deduction of $6,100. So the first $6,100 we pay them, they pay 0 tax on. Big goose egg.
Oh, wow.
0
okay,
tax.
$6,100. Okay.
And then they get to go up through the tax bracket. So if we're paying them $10,000, which I think is a reasonable wage for them helping around the office and doing things, let me back this up. You actually have to have them do stuff. It has to be legitimate, right? These aren't just things that, hey, let's just make this stuff up. Have them work for you. Give them chores, but pay them for it. And I don't care if they get their money or not. You can use it to put into an IRA for their college fund, whatever. But $10,000. So now we're using part of their 10% bracket. If we pay them $10,000, it's going to cost us about $500, no, $150 in self-employment taxes and in their income taxes. So let's just say it costs us $500 to pay our kids $10,000. We just saved $3,000. So we netted $2,500 for every one of our kids that we paid. So that's a huge strategy right there. And you can pay them W-2, which is the best. We've gone back, and actually we had one client who had given her daughter over $24,000 for her school and for medical costs and all of her expenses at college, and wasn't able to get any benefit for that. But she had actually given the money to her daughter, and her daughter actually paid that money to the school. So what we did is we went and reclassified that as a wage. Yeah. So she
got
grandkids?
Jeff's got a good question. How about grandkids?
Absolutely. Absolutely. You can pay your grandkids. They can work in your business. Really, the strategy is how do we get the income off of our return and onto somebody else's at a lower bracket. And then the power of the fiscal year end. That's what FYE stands for. So your S-Corp and your business and you personally, you all pay taxes on a calendar year end. That means as of December 31st, whatever your income was, you prepare your taxes and you pay that tax by April 15th.
Yep.
A fiscal year end, a C-Corp can pick any year end it wants. So it might have a March 31st year end, it might have a November 30th year end, it might have whatever you can choose, and you choose that when you set it up. Why does that make a difference? So let's just think about this. It's coming towards the end of the year, you know you're going to have a lot of taxes to pay, and you say, hey, I like the C-Corp strategy, and you start your C corporation on November 1st. That means that's the first month of its 12-month year, so it goes all the way around to October 31st. All right? So you pay it sometime in the last 2 months. You pay, well, we'll use that $150,000 over into your C Corp. You file your taxes on the $150 less the wages, you know, just like we walked through, ending up with $147. You pay that on April 15th. What about the income tax on the other $150? Well, that tax return isn't due until January 1st of the year following when you paid your tax. So you get a tax deferral. Wow. You don't have to pay that tax for the C Corp for almost 15 months.
Wow.
What would you do with all that tax money, Scott, for 15 months, right? I bet you could figure out a way to make some more money with it.
Absolutely, absolutely, for sure. Tons of money.
That's that income shifting strategy. Now, I told you there were more and better deductions in a C Corp. So I'm going to walk through them, and I'm going to go through these kind of quickly. Now, I put code sections here, not because I'm the geeky guy. I told you I didn't look like that guy on the H&R Block commercials, right? But I put code sections here because inevitably somebody will write down a note, and then they go to their CPA and they say, hey, I listened to some CPA on this webinar, and he told me that I could take 100% of my medical deductions. And they said, you can't do that because it's taken totally out of context. So it's Section 105, medical deductions. Here's a big thing here. There's no AGI limitation like there is on your personal return. It's 100% deduction. So what does that mean? I don't know what you pay for health insurance. Mine goes up every flipping year, right?
Yeah, right.
You got a little bit of out-of-pocket and this and that. But let's just say you paid $15,000. Let's call it 20. Keep my math easy, right? $20,000. Well, under our first scenarios, before we shifted income into the C Corp, you would have to have over $20,000 before you even got any benefit for your medical deduction. Any. So you paid 20 grand, got zero benefit. In the C Corp, it's 100% deductible. So you just took $20,000 worth of expenses and were able to deduct 100% of that. How cool is that? Wow. I mean, that in itself, at 30 grand or 30% or whatever the number is that your tax rate is at, is $6,000. I mean, that's a huge savings. Then there's Section 74 awards. Now, C Corps, I told you, they've been around forever, right? So some of these have just been written into the tax code. 74, as you can see, is a very low number as far as tax code. What is an award? Well, C Corps can pay themselves or their employees awards. Maybe it's a longevity award. Maybe it's a safety award. It doesn't really matter. And these aren't huge tax savings, but they're kind of fun. So if you pay it out in cash, it's $400. You know, that's not very sexy, but it's kind of cool. But what about non-cash? What if they paid you a longevity award, $1,600, and sent you and your loveliness, your wife, your husband, whatever, to Florida for a weekend, or to Vegas, or wherever? It doesn't really matter, right? It's a non-cash award, $1,600, freebie, totally deductible by the C Corp. Is that awesome or what?
That's awesome, man. Because I do that stuff right now. Yeah, that's huge.
Yeah, you're paying for it anyway. You're just not deducting it, right?
Right.
So Section 129, dependent care. Again, if you have kids and you're paying for care for them, on your personal tax return, there's limitations. Through a C Corp, there's no AGI limit. It's 100% deductible. So if you're paying 10 grand a year in dependent care for your small children, that's, again, if you're in the 33% tax bracket, just federal, that's a $3,000 savings. Education, Section 127. This is super cool. I don't know where your kids go to school, if they go private or if they go to college. Again, before we shift the income to the C Corp in the high tax bracket, you're going to lose all the benefit of the education, tuition credits, all of that kind of stuff. Through a C Corp, you get to pay up to $5,250 per year per employee. So if your kids are already an employee and they're going to a private high school, that might not cover their tuition, but right now you're getting zero deduction for it. At least you get a $5,000 deduction for it. If you're using this strategy to shift income, the C Corp can take $5,250, and then the balance that's paid by you personally, you get the tuition credits and stuff like that you wouldn't have been able to get had we not employed that C Corp strategy. So that's huge. Physical fitness center. I don't know about you, but I think we can always stand and maybe lose a few pounds. But if you have an office in your home, and let's just say you decide to put in a home fitness center, that's not deductible in an S Corp. It's not deductible by you personally, but a C Corp can pay for a physical fitness center. So how cool would that be to say, hey, I'm putting in a home gym, my C Corporation is paying for it, right? And it's 100% deductible, Section 132.
Awesome.
Cafeteria plans. These are available to every scenario we've talked about so far, the sole proprietorship, the S Corp, the C Corp. Section 125 cafeteria plans let you pay for certain out-of-pocket items like dental and child care and all of this stuff with pre-tax dollars, okay, up to some limits. But anytime you can pay those expenses with pre-tax dollars, you're saving about 40%, right? So that $10,000 bill now costs you $6,000 because you didn't have to pay tax on it before you paid it. So it's always smart to pay stuff with pre-tax dollars. This one I love, Section 243, dividends received deduction. So let's just say you have a mutual fund portfolio or a stock portfolio and it's kicking out dividend income. Kevin O'Leary, when he spoke, said, hey, I want to know when I get my cash back, right? He likes dividends, he likes royalties, things like that. If that same portfolio that you have outside in your personal account making $10,000 in dividends that Uncle Sam takes a haircut on every single time, if that's owned inside your corporation, you get to exclude. That means you don't even report. You say 10,000, but I'm only paying tax on 2,000 or 3,000 of that. That's the exclusion that you get with the C Corp. Amazing. And then we haven't even talked about state taxes, right? We've alluded to them a little bit, but most people think, well, I got to pay state taxes on my C Corp too. No, not necessarily true. Now, everybody's situation is different, right? But how many of you have heard of a C corporation or a corporation being set up in the state of Delaware? A lot, right? Or how about Nevada? Now, I personally like Wyoming just because it's like Nevada, no taxes, better asset protection, and they're less expensive to run and manage. So I love Wyoming Corps. But no matter where, those are states with income tax free, right? So now on that income, maybe we don't even have to pay state taxes on that if we structure our corporation right. And of course you get liability protection with your C Corp, just like you do with the S Corp or the LLC if it's set up and taxed the right way. So you're probably saying, hey, okay, Vern, got it. Why isn't everybody doing this, right? Well, there's some myths about C Corps. And the first myth is that they're complicated. Oh gosh, I got to worry about this extra tax return, and what about corporate minutes and all of this? Well, the reality is they're no more complicated than your S Corp, and they're no more complicated than a limited liability company. All right, you have to do that extra stuff for those as well, so they're really not that complicated. And then you've all heard about double taxation. Oh, you don't want a C Corp because it's double taxed. There's one instance of double taxation, and it's real, right? So if a C corporation pays out a dividend to its shareholders, which would be you, it pays out a dividend. The corporation does not get a tax deduction for that, but you have to pick it up on income, so you can see the double taxation. So why is that a myth if you just told me it was real? Well, the reality is that's the worst way to take money out of your C Corp. The worst way. So if you structure it properly, you don't ever have to take a dividend, and you never ever should, right? You get to take advantage of all these different deductions, and some of them we haven't even touched on, right? This is just like the tip of the iceberg. You get to take advantage of all these other deductions. There's no reason to take a dividend out of your C Corp. So I think, you know, we had $37,000, almost $38,000 worth of tax savings with the income shift that we kind of did. And then we've got all these other deductions that are a few $1,000s a year. There's no reason not to use a C Corp in your strategy if you're at the right income level. And again, your situation might be different, your income might be lower. This to me is like phase 3, right? A lot of people start with the sole proprietorship, then they go to the S Corp, and you might be ready for a C Corp strategy. If you are,
well, and a lot of people are asking what that income is. Like, at what income does the C Corp make sense?
You know, you probably need to be at close to $150,000 to $200,000 bottom line income.
Okay. There you go. And then if you're not there yet, say you're at 100, what would be the? I mean, what would be in?
You should be in an S Corp right now. Doing as much as you can with some of these others like the 125 plans and paying your kids, and you can still shift income by paying your kids out of your S Corp. You need to be using some of those strategies to reduce the amount of tax and your marginal tax rate on your personal tax return.
Cool.
So, let me walk through how to set up a C Corp.
Yeah. And I got a bunch of questions coming in. We'll answer all these at the end. We got plenty of time for questions, and so we'll go. And some great questions coming in, Vern.
Awesome. Well, that's why I'm going fast too, because I want to make sure I answer as many as I can. So how do I implement? Okay, you choose the venue. It might be your home state. It might be a state like Wyoming, Nevada, whatever. You choose a venue. You file articles of incorporation with their Secretary of State. Then you choose a fiscal year end. A lot of that depends on whether most of the income's coming into the C Corp and you're shifting some out, or if you're bringing your income into your S Corp and you're shifting some into the C Corp, on what fiscal end you want to choose. And we'd help you do that. You create bylaws. These are pretty boilerplate. They just basically say, hey, this is the president and what he does, the secretary what he or she does, you know, on down the line. Then you get an EIN number from the IRS. open your bank account, and you're in business, right? So it's pretty straightforward. Obviously, I simplified that a little bit, but it's not complicated, right? It's pretty straightforward. Mm-hmm. So that strategy in itself, I mean, what are you willing to do if you could save 50 grand in tax a year? I think a C Corp might be part of it. So let's dive into another one. Is everybody ready? Hope you're taking notes. I know you're recording this, Scott, so we're going fast. But core strategy number 2, I call it the retirement plan strategy, right? Everybody wants to put away something, whether it's in investments or a structured retirement plan. Everybody wants to put away something to take care of them when they don't want to work. Retirement means a lot of different things to a lot of different people. Some people say, I don't like what I do and I'm just going to quit and do what I love to do. Some people say, I've worked my whole life hard and I want to sit on the couch and eat bonbons and watch James Bond movies or something. The other strategy is I love what I do and I want to use a retirement plan to supplement because I want to work when I want to and not because I have to. Whatever your strategy is, a retirement plan is part of that. Now here's what we all hear of, right? These are the most familiar plans. They fall into that category of defined contribution. That means the contribution, the amount you can put in every single year, is dictated or defined by Uncle Sam. So you've heard of all of these, right? A traditional IRA, a Roth IRA, a simple IRA, a SEP, or a KEO plan if you've been around that long. 401ks, Roth 401ks. I mean, the list goes on. You're thinking, oh my gosh, what do I choose? The bottom line with these is if it says Roth, you don't get a tax deduction now and you pull it out tax-free later. If it doesn't say Roth, you get a tax deduction now and 100% of what you pull out is taxable later. These aren't good or bad or indifferent. It's just what works for you. The thing about all of these is they're all limited, right? Every single one of those has limitations on the amount of money you can put away. Now at some higher income levels, you know, maxing out your 401k doesn't really mean a lot from a tax deduction standpoint. So what's the other option? Well, the old becomes hip again, right? How many of you probably realize that either your parents or maybe your grandparents, the whole concept of let's work for a company for 30 years and at the end of that they'll pay you a pension for the rest of your life and maybe even get a gold watch with it, whatever. Those are defined benefit plans and they've been around forever, all right? They're still around and people still use them. And they're pretty inexpensive to set up. You can set up one at Schwab for like $1,200. And you might think that's a lot, but when I tell you what this is going to do for you, I think you'll be surprised. So this actually defines the benefit. So what does that mean? We're going to actually say what we want in our pot, retirement pot, at the end of the day to retire on. And so how do we do that? We pick a retirement income. Now they give us some guidelines, but it's basically your highest 3 years of salary. That's going to be your target retirement income, an average of those, and you're going to want to draw that for the rest of your life, right? So we might have to put a big pot of money away. The other thing is your target retirement age. It doesn't have to be 70, it doesn't have to be 65, it could be 55. It just depends on your age, what your target retirement age is. You do not have to work forever. So you pick those two things. And then a plan administrator or an actuary actually calculates and says, based on these two things, here's how much money you can put away every year. Okay, so that's pretty cool. It sounds complicated. It's not. All right. Now there's a couple of things. You pick that. The limit is $210,000 a year. But here's something new I want to talk to you about. There's actually plans out there called focused benefit defined benefit plans, and so that $210,000, you know, that might be, and you don't have to make that amount, right? It could be anything up to that. But that might be over a period of, say, 15, 20 years to get you the pot that you need to take care of the target retirement income you picked. Well, what they've come up with is a focused benefit, defined benefit plan. And really what it is, and some of you might be in this target area, some of you might not be, but I'm going to share it with you anyway. It really takes that $210,000 over a long period of time and shrinks it down into about 5 years. So a plan administrator that I work with, he just calculated one for a guy in Michigan. He's making, you know, about $1 million a year, and he said, I'm getting killed on taxes, which he was. But with his focused benefit, defined benefit plan, he was able to put away over $500,000 a year for a 5-year period. So really what you're doing is you're taking that whole thing and you're compressing it into a short period of time when you know your income's really, really good, right?
Yeah.
So some of you are saying, hey, my income doubled last year because of what I've been doing with Scott. So as you project that out, you think, gosh, maybe I could put away a chunk of change.
Start banking some money, absolutely.
It doesn't have to be $500,000. It doesn't have to be 210. No. What if it's 100?
Whatever. Yeah, whatever.
What if it's
10,000? I mean, it doesn't matter, right? It has to be a minimum of 210,000.
No. That's a max. But when you shrink it under that focus plan, you can actually go over that max.
Got it.
Shrinking it. So here's the deal. It's actually pretty flexible, right? But it gives you way more power than you have in all those other traditional IRAs. Now, there's a couple of things you want to watch out for. The IRS considers this a permanent plan, right? So what does that mean to them? Well, the IRS obviously didn't look up Webster's version, but they say it has to be around for 5 years. So a defined benefit plan is not something you say, hey, I'm going to do that, and you do it for a year and want to get out, okay? You need to do it for about 5 years. That being said, inside of those 5 years, it's actually pretty flexible, right? The other thing you need to do is look at your other businesses. If your Loveliness has a different business and they've got some employees, you got to take all that stuff into consideration, because with a defined benefit plan, it's global. So it covers your company, any other companies you own, and your Loveliness's company as well. But like I said, it's actually flexible, so you can actually change that target retirement income, you can change that target retirement age, and you're not changing the plan. So, wow, I feel like we went super fast, but these are tax strategies. So these are really a few of the tools. What you really want at the end of the day is you want a strategy that works for your business. Everybody's situation is different. You need something that works for you with your goals. You need a strategy that's flexible, right? You don't want to get locked into something that you can't continue with or don't want to continue with. So you want that strategy to be flexible. And then you really want that strategy that gives you freedom. I mean, if you really take a step back from all of it, it comes down to this. You want to be a good steward of your money, right?
Right.
I asked you earlier, are you a better steward or is Uncle Sam? You are, and you want to be a good steward. You want to have freedom. And really, it just kind of makes sense to create a plan to give you that freedom, to help you get that freedom. So.
Right. So, hey, so we ton of questions. One of the biggest things on here, Vern, is I love this content, but I need help. So, can they, like a shameless plug, because this is what you do for a living, obviously. Do you work with people in all states, and do you have some way that people can get a hold of you? And what do you have for people on the call today? Because there's a bunch of people here going, hey, this is great stuff. Why would I not want to save $10,000? Minimum $4,000 all the way up to depending on what you're making, of course. There's some other great questions I want to get to as well. So you want to let us know how somebody would get with you, work with you, the opportunity that you have for us.
Certainly. So first of all, I have clients all over the country. Okay, from Florida to Maryland to Texas and Chicago and California and Colorado, all over. So there's really no limitation on where my clients come from. But here's what I can do for you guys. Really the bottom line is just let me help you create your plan, right? That's what I can do for you. Let me help you create your plan. Whether you use me to implement it or not, let me help you create it. And here's how that would work. You can go to save50kintax.com. Remember, that's my goal. I want to save you $50,000 in tax. So save50kintax.com/strategy. All right? Now, here's how I run this system is I have you leave a show-up deposit. It's totally refundable. I don't want your money. The reality is I just want to stop time wasters, people who don't really want a strategy, that don't really want to do anything. They just got a question that they don't want to call their CPA.
Pay to show up. Right? So totally get it. Yeah, so show up.
And you all know when you have a vested interest, you learn more. Totally refundable, the deposit. So then Carol, my assistant, she's been with me for 14 years. She's going to call you to set up a time for talk. So we're going to have a strategy call. It'll go from probably 30 to 60 minutes. Depends. During that call, I'm going to learn more about your business. More importantly, I'm going to learn more about your goals. What are you trying to achieve? What's your end goal? because no strategy is complete if we're not achieving our goals.
What's the finish line?
Yeah. And then where are you now? So now we know where you are, what your business is like, what it's going to contribute, what your end goal is, and we create that strategy on how to get there. So we create that strategy that's going to work for you, not for your neighbor, not for the other guy in the office, whatever, for you.
Not what Vern thinks, right?
Yeah, right? So at the end of the day, really, here's what it does for you, right? You're going to have a plan that's totally tailored for you that you can implement. I can't say guarantee very often, but I will say I can show you at least how to save several $1,000s on your taxes. And really, you can take that and turn that into getting your freedom. So after that call, one of three things is going to happen. You're going to say, hey, Vern, I love this strategy. I appreciate it. I've been working with my CPA forever, and I'm going to have him implement it.
Perfect.
I'm going to wish you good luck, and I'm going to refund your deposit. Told you, totally refundable. Number two, we may decide we're not a good fit. It doesn't happen very often, but once in a while, I don't think I'm going to be able to help you, and I'll be upfront with you about that. And I return your deposit and say, hey, good luck. I wish you the best. Or you'll love the plan and you'll say, I can't believe nobody else told me this stuff or has been proactive in planning and strategizing with my taxes, and you'll say, I want you to help me. And then in that case, you become a client. And then we run our practice a lot differently than most CPA practices. Basically, you've got your financial quarterback. We're going to implement the strategies of the plan. We're going to prepare your income taxes every year for all your entities and your personal, your kids if we need to, right, whatever it is. We're going to consult monthly, and here's what's important. Every month we're going to get on the phone.
Yeah, I like this part.
It might be 15 minutes. Yeah, it might be 30. It might be an hour. I don't know what you need in that particular month. But we're going to talk and say, hey, here's what we need to tweak, here's what we need to do differently, here's some changes in my life. We're going to talk about your goals and make sure you're staying on track, not just on taxes, but in your whole financial path. And basically we're going to do that so you can focus on making money, right? That's what you should be focusing on. Everything you learn is about how do you generate more income and be more efficient. So we handle all that for you. So all you need to do is just go to save50kintax.com/strategy. Leave your totally refundable deposit. Carol will call you within 2 days, right, unless it's a weekend. She takes weekends off. And we get on the phone, and we strategize. And I'll create a strategy for you, and
go from there.
We'll go on down the road.
And how much is
that? No risk for you.
And how much is the deposit? It's
$500.
Okay, cool. All right.
Yeah. It's just, it's something to keep you vested.
Absolutely.
And to say, hey, I'm going to show up and not waste your time. So
very cool. So first question so if you guys are interested, want to call with Vern, again, 100% refundable. You have a strategy session, which I really appreciate you doing that for my people. And again, the 500 is just so that you show up, which is nothing more than that. If you work together, great. If you don't, it's 100% refundable. So I just want to make sure that's very clear. Elro, appreciate you being here, man. So in Michigan, brokers can only pay a licensee pay a licensee as licensed. In other words, as individuals. That would mean the 1099 would be issued to the individual Social Security number. Can the individual move the income to the S or C corp? Great question.
That's a great question, and Michigan's no different than many states. There are a few states that let you go right into your corp with it, but most states pay you individually, and then you make that transfer over into your S corp. So here's what my clients do in those situations. A client I had in Texas, same thing. The same situation came up. She had a Schedule C, wanted to go to an S corp, and she knew other people in the office were doing it, but the attorney and everybody else said, well, wait a minute. I can only pay these commissions to you individually. So here's what she did. She takes her check and she deposits it into her S corp. Okay. Now, we get a 1099 for you individually. I put that on a Schedule C for you. Let's just say it's $300,000 since that's a number we've been using. Down in the expense section of the Schedule C, I put income reported under employer ID number, whatever, for the S corp, and I put a $300,000 expense. The IRS recognizes that as valid, okay? And they have for years and years and years. So it shows up as zero on your personal, and now we report all the income in your S corp.
Got it. Awesome. Great question. All right, Robin. So a lot of talk about S corp, C corp. It says my understanding is unless I make a certain income level, the administration of this tax strategy by the CPA is cost prohibitive. If that is true, what is the suggested income level? So at what income would they be a good fit for you, or doesn't it matter?
You know, my minimum for clients, and this isn't my minimum, it's just kind of how it's worked out with me creating strategies,
right.
Is really kind of 150 to 200,000.
Okay, that's what you said. Okay.
I think the S corp strategy probably makes sense anything over 50 grand if you're doing it right. Now, a lot of people don't, but if you do it right, if you're making 50 to 75,000, there's no reason you should be paying self-employment tax on all of that. You should be using an S corp.
Okay.
And then the higher amount for maybe adding a C corp to that strategy.
Perfect. How much should I expect to pay someone to set up a C corp, and would that be a tax preparer?
It can be a tax preparer. Typically what they do, a tax preparer, like, we'll walk you through the process. I like to use an attorney, but an attorney doesn't have to do all of it. I would say a standard fee for setting up a corporation in most states is $1,000. A corporation fully set up in Wyoming, one of the reasons I like to use them, is $500, and then it's $100 a year to keep it. Cheap, right?
Yeah, right on. That's cheap. Yeah. What do you? Here's a good one. Kathy, I told Kathy she didn't have any kids. I said, she can adopt me, and then we could kind of work that. So Kathy says, what if you don't have any kids? Is the C corp worth doing?
Kathy, I'm going to give you my favorite answer for most things, especially when I don't know you yet, is it depends, right?
Okay.
It truly depends, because answering a blanket question like that is tough because I don't know your situation. Your situation might be where you have high medical costs, and that might be a reason in and of itself to have that C corp. So there's a lot of variables. You do not have to have kids to use that C corp strategy. It's a way of shifting income without paying your kids, quite frankly.
Very cool. All right. You said you save money with the S corp by going back a year. Can you go back 3, 5, 10 years?
Okay, let me qualify that. You can go back and amend, but the situation that I talked about earlier, and if you didn't miss it, is the S corp had already been set up, just was not being used.
Okay.
So it was already in existence, and so that's how we were able to use that strategy.
Great.
So. Yeah,
so if it's not set up, then you couldn't use it on 2013.
Right. So we would use it from the day you set it up moving forward.
Okay. All right. How do you get funds back out of a C corp? Would they not be taxed as in dividend income on the personal return?
No, there's a lot of ways to do that, and typically what my clients who are super successful with their C corps is you have all these other deductions, so there's not a lot of need to actually have to pull cash out personally if you control what goes in. So if you know what you need to put in to take care of all these other things and save the taxes, you don't have to worry about pulling it out. That being said, there's a couple of different ways. You can borrow money from your C corp when you need it. C corp can fund like life insurance programs, things like that for you, in which you can pull money out of. Also, rent is a great way to do it. So if you have an office in your home, we talked about the fitness center in your home, things like that, you can have them pay rent, and let's just say that number's 20 grand. So they pay rent to you 20 grand, but you've got $20,000 worth of deductions, so you just got that $20,000 tax-free, quite frankly.
Got it. So another one, what if a child is a toddler? They obviously have to be able to do something, right, realistically?
That's a great question. Now, I've had some people who've wanted to pay their kids very, very young. I used to speak on stage a lot, and when I did that, I would show pictures of my kids when they were young. That's a different kind of income for them, right? But I was able to shift money from me to my kids because I was actually paying them almost like a royalty fee for being part of my presentation. That works. As far as paying a salary to, I like teenagers, quite frankly.
Yeah, right. They can do something right.
But I started working when I was 7, and my dad paid me, and I was working hard when I was 7. On a case-by-case basis, I think you can justify paying a 9, 10-year-old if they're working.
Cool. Here's another one. I elected to have my LLC taxed as a corporation. Do I have the same benefits as a C corp you are describing?
Okay, I'll walk you through that in about 30 seconds. So you set up an LLC, you elected to be taxed as a corp. Now you have two options. You can either elect S status and use that as an S corp, okay? You'd file a form 2553, or since you made that election to be a corp, you're automatically considered a C corp for tax purposes. So you're going into one of those two buckets, you just get to choose which one.
Cool. And BR says, I file jointly with my wife. We both are W-2 employee, but my wife also has consultant income, which she claims as a sole proprietor. How do we take advantage of the tax savings you discussed with the income she declares as a consultant if it's right around 60?
Okay. You're probably in a great position to have that run through an S corp. Because right now she's paying SE tax on all of her Schedule C income, and you could control that amount using an S corp for her consulting practice.
Cool. Awards. Is the 400 cash or Vegas trip taxable to the person receiving it? Great question.
No.
No, so the person receiving it doesn't have to claim it.
That's right.
Because it's not on a 1099 or W-2. It's an award. Okay. A gift. Okay. Somebody says, what about homeschool? And I'm not sure what she's referring to there.
Okay, so maybe the Section 127 education deductions.
Okay.
So if they're an employee of your corporation or whatever, you can actually pay their homeschooling costs. Now, if you paid yourself as their teacher, you'd have to report that as income. But if you pay for, like a lot of homeschool programs are online and they have a tuition associated with them, that could be deductible through the corporation.
Excellent, excellent. Thank you, man. Here's a good one. Sorry to hear that this happened. I was bedridden due to an accident and majorly needed to have my taxes done for the past 3 years. Is this something you can do?
Yeah, absolutely. I mean, we've gone back and done them for several years and would love to help you out if we can.
Hope you're doing okay on that. Hope you recovered fully. If I had an S corp in prior years and did not use that when filing and didn't file on the S corp because I did not generate business through that S corp, basically I was holding that name for plans for the future business. Not sure what the I would. Maybe he's asking if he can use the S corp. I think.
Possibly. So here's the situation there. I mean, that's definitely worth it. Go to save50kandtax.com/strategy. Let's talk about your personal situation. You may be able to go back. Sometimes you can go back and amend your prior year's taxes and file. Sometimes it makes sense. Sometimes it doesn't. That's one of those things you just got to look at on a case-by-case basis.
Let's see. Laureen, great joining us. She's even on vacation, Vern, and she's joined us here today.
Oh, so, thank you.
Awesome.
That's sweet. I appreciate that.
That's right. You know, and I asked you this question too. So she says, you state $500 deposit. Would there be other fees, Vern, by charging for his services? And that, you know, go ahead.
Yeah, so basically what that $500 is basically show up, we'll create a strategy. Let's say you decide to become a client. We figure out how we're going to apply that $500 to whatever our fee is. What I do with our fees is we figure out what we're going to do and what your specific situation is. We come up with a fee that we agree on, no surprises, and then I just break that up into 12 monthly payments. And so whatever that fee is, that $500 either gets applied or sometimes we'll go back and do some work for part of that $500. So I'm super upfront about fees because I don't like fee questions and I don't like dealing with fee issues. So I want to make it easy for you. We agree in advance on what those fees are.
Cool. And the last two questions, I appreciate you hanging out here. So if I start a C Corp on 8/1/2014, can I make my FYE 1/1/13 to 7/31/2013? That would be a no, probably. I would have to start.
Yeah, no. The C Corp starts the day the Secretary of State stamps it. So you need to set your fiscal year end at some time in the future from that date.
Here's a great question I'm going to finish with, and if anybody has any other questions, would like a copy of the recording and the PowerPoint, just contact the loan professional that sent you here, and they will be more than happy. It should be up later today, if not first thing tomorrow morning, and they can help you with that. Also, if you, for some reason, were invited here by somebody that you don't know who your sponsor is, if you send an email to amminvite@gmail.com, we'll get you hooked up with a sponsor. So last question, and this is a good one. Recommendations, could you help, and you probably have, recommendations to avoid inheritance tax?
Oh, absolutely. We could do a 2-hour
class on that one?
presentation on estate planning. A lot of my practice deals with asset protection and estate taxes.
Okay.
So, you know what? I don't know your specific question. The short answer is yes. I've helped hundreds of people with their estate taxes and inheritance taxes. So
Okay.
if you want to talk and want me to give you a strategy, I'll do that. And if I don't do anything for you, you get your $500 back anyway.
There you go. Yeah. So yeah, if you guys have a bunch of questions and you think that there's a benefit here, of course, it's $500. It's 100% refundable. We're not trying to sell you anything. The only reason it's there is so you show up for the appointment. That's what it's there for. If you guys decide not to work together, it's 100% refundable. Of course, if he can save you $4,000 in a year, it might be well worth the $500. So, all right, guys, that's it. Vern, thank you so much for being here again and sharing your wisdom. I can't wait to get our thing started together. And yeah, man, if you have any question, concerns, go to our Facebook page, facebook.com/groups/Agent Mastermind, and Vern is a member of the page, so he's more than willing to answer any questions that we didn't answer there. I appreciate you guys. Honored to be a part of your lives and your success, and now your tax savings. How's that? Is that cool stuff? We can make money, but let's keep it. Amen. So, Vern, I appreciate you, brother. Hope to meet you someday soon. And, guys, next week got an amazing class plan for you. We have a guy that specializes in photography for real estate agents. So he's going to be here to share with us his expertise. So we'll see you here, same time, same place on Agent Mastermind. Everybody have a safe, exciting, and fun rest of the week. Take care, everybody. Bye-bye.